Richard, welcome back to FNN.
My pleasure.
The first quarter of this year has seen the Australian share market trend higher, but where do you see the benchmark index ending the year?
We certainly see it. It's probably got another 3 to 5% increase in it this year. Certainly the earnings period that's just passed us has been more favourable than was first expected, although there's been quite some disparity there. But certainly the momentum is still for the upside in relation to the index and the performance.
2014 has already been marked by fears over emerging markets, US tapering, some disappointing Chinese economic data, and rising political tensions between Ukraine and Russia. Which factors do you think will threaten to put the greatest downward pressure on the ASX?
Certainly how China plays out with its reform package and its financial sector reforms is very important for Australia. Really the Ukraine and the geopolitical issues over there, not so great an impact, although we need to watch the impact, of course, on gas prices in relation to the Ukraine's pivotal role with Russian gas suppliers.
Turning to the RBA now, it has just kept rates on hold at a record low of 2.5% for its sixth straight meeting. When do you think we'll see the next move, and what will it be?
Well, we've actually recently moved to remove one of our rate cuts that we had in there for this year, so we don't expect that there will be another rate cut until, if there is another rate cut, until the second half of this year. And that will be in response to some further deterioration in the labour market and quite possibly some extra fiscal drag coming through in the May budget.
Now, the RBA has made no secret of its view that the Australian dollar is uncomfortably high. What's your fair value for the local currency and forecasts for its movements?
Our fair value is around 85 cents for the currency, which I think is probably the same as the Reserve Bank, but we think the Australian dollar is very good at undershooting and overshooting, so our undershoot forecast for this year is 82 cents by the end of 2014.
Now, Macquarie Group is Australia's largest listed investment bank, and its most recent outlook noted subdued client activity for some capital markets. What do you believe are the economic factors underpinning this outlook?
Well, there's a big economic financial factor, I suppose, and that is the lack of credit growth in the global economy and in the Australian economy, and the fact that corporates in particular are still sitting on quite large war chests of cash. And so their unwillingness to invest, so the propensity to invest in terms of the macroeconomics, is really one of the main restraining factors.
Now, separately, Macquarie took the lead for Australian equity underwriters last year for the first time since 2004 and scored roles on some of the year's largest IPOs. So, Richard, what's your outlook for Australia's IPO market in 2014?
Look, I think it's going to be reasonably buoyant, and where we've seen that growth, of course, has been on the service or the traded services side in relation to companies that are trade exposed on the services side, particularly in education services, healthcare and the like. Those sectors are set to do well in Australia in 2014, and I think that is going to usher in further IPOs in that area.
So, Richard, for Australian investors, what's your best piece of advice to preserve and grow capital this year and beyond?
I think they've really got to look for value in relation to equities. There are a number of industrial companies now that are trading at very, very expensive price earnings multiples in excess of 20 times. That means they are expensive stocks to buy. You have to think about just where that earnings growth is going to come from. So I think we've got to continue to look outwards and have a nice diversification in relation to our asset holdings between domestic assets and, of course, those offshore international assets which have a far bigger universe to select from.
Richard Gibbs, thank you so much for your outlook today.
My pleasure.